Smart recovery after a terrible session yesterday. In fact, we are looking at almost 400 point on the bank Nifty, which fell almost 1,000 yesterday. It was a 500 point cut on the Nifty 2 yesterday, which happened only thrice last year, mind you. That was the rarity of the event. And now we are looking at almost 150 point rebound. Whether we'll go back or knows, who knows? But what should you be doing, and how are practitioners of money management actually approaching things? Let's take it forward with Santosh Singh, fund manager and head of research at Motilal Oswal AMC, is joining us. Santosh, good afternoon. You understand the financial space very closely and track it too. Santosh, financials have been the biggest drag lately. Which part of the financials do you think the risk rewards are stacked most favorably if one were to take a 2 to 3 year view?
See, financials have been a drag on the stock markets, right? But if you look at the EPS from an EPS perspective, they have been the ones which have seen the highest upgrade. So it's sort of a dichotomy where the sector which is seeing the highest EPS upgrade is turning out to be a drag that way. And that's more linked with maybe flows than the fundamentals. And that's what we need to remember, that when things are linked more with flows and less with fundamentals, then the reversal of trade is also that high. So I'm broadly bullish on every bit of financials, but if you are specifically, see, the two areas which I like are some of the large banks. This is an area which I think can do really well. And then it's one area which I like for very long duration is insurance, which has done really badly for last 2-3 months, at least 6 months, I would believe. The stocks have done really badly and the companies have done phenomenally well because the growth rates have been very, very high. So these are the two areas which I think make a lot of sense to me.
Right. Santosh, I agree. I mean, I was looking at insurance stocks myself. I was surprised. The numbers are good. Things are good on fundamentals. Perhaps got to do with the ownership, because FI had a very large exposure here. And FI have been the biggest sellers and it continues. So from this current valuations, do you think 30-40% upside in next 2 years is not ruled out? Does it look that attractive and juicy, the insurance basket?
See, we are actually overweight on that sector. In my fund, I'm quite overweight on this sector, and I clearly believe that this is an area where I'm not looking at 20-30% upside. I'm looking at much higher upsides here because if a particular in a sector, if the stock companies are growing at around 20-30%, and if the stock has fallen 10-15%, then the delta between the stock price and the fundamental is significantly higher. And then it's not that it is in line with expectation. It has been better than expectations for a lot of companies. So that way, I'm looking at the much higher upside in these particular names.
Let's come to the other side, and that is the public sector banks. This time, the quarterly results of public sector banks are phenomenally well. I mean, barring any exception, BOB, Union Bank, Indian Bank, SBI, PNB as well. And so what kind of outlook do you have on this basket if one were to approach it in a 4-5 name, 7 name basket?
So it's a cyclical side of the business in banking. It's hugely cyclical, and actually now the cycle is on their side because they have gone through 7 years of almost a sort of bad phase where they were writing off loans. They have gone through the consolidation of their book, which has meant a lot more of the problems. They were not able to grow because a lot of them were under PCA control by the RBI. So this sector has gone through a lot of this. Companies have gone through a lot of pain over the last 6 to 7 years. Now that the tide has turned and they have written off the assets and now they are into recovery phase. So one is their profitability suddenly will be impacted by two things. One is the recovery and second is just the normal credit cost, right? The credit costs are normalizing in these companies. So what you will find is that the underlying profitability, underlying PPOP getting translated into profitability will be much, much more higher now. So that way these companies are in a cyclical sort of phase, and unless and until we see any disaster happening in the economy, next 2 to 3 years can be really good for these companies because they can grow as well. Now they are out of all sort of frameworks. They are They have the ability to grow. They always had the deposit side of the business. So they can grow not so much as the private sector banks, but there will be some growth, and then the profitability growth will be much more higher. So actually next 2-3 years can be very, very good for these companies.
What is troubling NBFCs? I mean, the entire basket of NBFCs, housing finance, including others, commercial, vehicle financiers, and all of them. I mean, they are also sharply lower, and the business outlook appears mixed. Would you stay away from that space?
See, NBFCs, in a way, I've always said they are multiple sectors. That's not one sector. And there, the impact of COVID, because they are the ones who do business into more of so the top end is taken care by the banks, and they are more into the semi-urban and rural side of the market, where the impact of COVID was much more higher. So yes, they had problems for multiple quarters now. If we are not expecting that there will be another wave of COVID, then actually they have also written off majority of the problems. So they can be like where PSU banks were, say a year and a half back, they are almost at that phase. So after say 6 months or a year, we may say the same thing about them, that the numbers are looking extremely good. So unless we see any disaster happening, right, that is because on COVID I have no view. So unless and until we see any disaster due to COVID happening, these companies are now very well placed because they have capital, and they have distribution. Most of these guys have distribution. What impacted was their customer base, which was impacted due to COVID.
Santosh, there was NASSCOM, press conference today, and they have indicated at good growth outlook from here and also for the industry. Similar things were echoed by managements of the large cap IT companies, mid cap IT companies. In fact, one of the IT companies in their con call said NASSCOM is being conservative on growth, if you know which one. So, but at the same time, wage inflation is hitting them hard. How do you see that factor versus the valuation they are trading at?
So, see, on the growth side, I also believe that, and then whatever feedback we get from the market, we also believe that NASSCOM is getting a little bit conservative on that front, and we see for next 2 to 3 years significant runway on growth. So that is visible. So that's number one factor, that growth will be higher. Second is the margin side, which has been under pressure because of the employee cost. Right, so see, for them also growth came suddenly, and for that they had to hire employees at whatever cost they could hire in last 1.5 years. So that had an impact on the margin. So I'm not worried about growth or any reduction in margin from here on. But what I need to be sort of aware of as well is that most of these companies are trading at valuations which they have not traded in last 10 or 20 years, right? After 2002, 3, 4, a lot of these companies have not traded at these valuations. And the mid-cap IT specifically is trading at valuations which is even significant premium to the large cap IT. So I need to be worried about that particular factor. So the growth or margin, I'm not that worried, but I need to be sort of take into account that valuations could be not that comforting in this particular space. And see, the growth is not that we can say that this growth will remain for 10 years or 15 years. What we can say is that this growth can be, what the visibility seems like is for 2-3 years or maybe 4 years. So if that is the sort of visibility, then means whatever call on a stock level, whatever call we are taking has to sort of marry with the valuations. So I would say I would be very stock specific in this sector rather than going, it's not the time like 1.5 year back where you could have gone overweight on anything.
Right. And what about, lastly, I want to understand on auto and auto ancillary, because auto seem to be coming out of its 5-7 year vanvas, and auto ancillary is also following it.
So auto ancillary will follow auto sector, that's for sure. Auto OEMs, they are going to follow the auto OEMs. I think that there is last 2-3 years were really bad because there were so many factors. It was not just the demand side, there were also supply side pressure. Then we had COVID. They suffered from so many things for our last 2-3 years. So I would think that now that is the time when auto stocks or auto companies will start doing well. See, there's the only area where I have my own concerns is two-wheelers. Other than two-wheelers, I think four-wheelers and CVs I think the problems, the future 2-3 years could be really good, and also the margin pressures which they have seen because of the inflation in commodity prices, which they were not able to pass on in the past, and now they have been able to pass on. So next 2 to 3 years could be really good for auto segment. The only area I am slightly worried about is auto two-wheelers. One, the demand side is also not great because rural has been impacted severely, and this was the only segment which in the budget the government decided to not sort of look at. So that is the rural side is stressed. One, so from the demand side, and second part is that there is a transition happening which is on from to EVs, and I mean the transition, there are so many new players. Earlier there used to be only 3-4 players which we used to talk about. It was more of oligopolistic business. Now there are so many players which want to get into the space. So I don't know how this technology sort of change will happen over next 2 to 3 years. So that's the only segment where I would be a little bit skeptical about. Otherwise, auto seems really good to play.
All right, Santosh, always enjoy your inputs. Very educative chat today as well. Thanks very much for your time.
Thanks.
That was Santosh Singh of Motilal Oswal AMC. Time for a break. On the other side, of special interaction coming in from Religare. Rashmi Taluja would be joining us. On the other side, a lot of activity there. Some clarifications are sought by the market. We'll get them with Rashmi Taluja on the other side.